Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Friday, August 15th, 2025. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, how are tariffs impacting the U.S. economy? Part 3. Our answer: the July retail sales data supported our resilient U.S. economy theme, but signals more support for our U-shaped economy thesis in the months ahead. The July industrial production data supported our U-shaped economy thesis. Because we only saw a modest pickup in inflation in July, the fact that core retail sales beat and accelerated sequentially by 260 basis points to a well above trend 3-month annualized rate of 6.4%, the highest since July 2024, amid a much smaller inflation impulse in the CPI data, suggests another round of tariff front-running took place last month. Recall that the reciprocal tariff regime officially began last week. These dynamics suggest there will be payback from the likely pull forward of demand in the months ahead. Recall that both retail sales and industrial production are persistent leading indicators of the business cycle, according to the 42 macro business cycle model. According to these indicators, there is a low probability of a developing recession in the U.S. economy. This does not, however, mean markets will look through the worst of the U-shaped economy in the coming months. As we remarked on our friend Paul Barron's show yesterday, there's a 50-50 chance the subversive Powell Fed fails to supply the monetary easing required to support animal spirits and job creation throughout this rough patch of trade policy regime change. Markets are not in a good place from a positioning cycle perspective to digest our Jay wants a strong legacy theme well. Transitioning to our 42 macro dashboard, as always, we'll wrap up the question from our community. This one's titled 3% inflation target at what cost? It says, hi, Darius. I wanted to ask about the potential negative downstream impact of the Federal Reserve changing their inflation target to 3%. I understand you would expect this change to be positive for growth, but how might it impact things like healthcare costs for the elderly, retirement savings, median wage earners' ability to save for a house, interest rates on cars, homes, houses, etc.? Great question. I think this is the debate of our time. Our friend Jim Bianco was on Bloomberg, I think yesterday, essentially taking the other side of our view that the Fed needs to revise its inflation target higher in order to promote more growth in the economy. And Jim's obviously brilliant. I'm a huge fan of Jim. Obviously, he's a friend of ours. So, definitely it was a good reminder that there is another side of the debate, as much as I'd like to poo-poo the Powell Fed for what I think is just a legacy of terrible monetary policymaking. There is another side of the debate that is separate and apart from the Powell Fed and all their mistakes. And so kudos to Jim for bringing that up, and kudos to the client here for asking this question. Let me start by saying that very clearly the Fed can contribute to inflation with this monetary policy, but I think the assumption that the Federal Reserve acknowledging that the economy is now a structurally 3% inflation economy, as our secular inflation model has deftly argued every month since we invented it in January of 2022. Just because the Powell Fed acknowledged, the Federal Reserve acknowledges that we're in a 3% inflation economy, does not mean it's going to cause more inflation. Right now, what we, Darius Dell and many others, Treasury Secretary Scott Bessent, Fed Governor, Fed Chair candidate Kevin Warsh, Fed Governor candidate Steve Moran, Fed Chair candidate David Malpass, Fed Governor candidate Judy Shelton. These are some big voices in the academic economy space. Mohamed El-Arian, obviously somebody I have a tremendous amount of respect for. There's a lot of really smart people who agree with Darius Dell that the Federal Reserve needs to change its reaction function to the level of inflation, the equilibrium level of inflation, which is transposed higher in the post-pandemic economy. We are no longer in a 2% inflation economy. So if you have a 2% inflation target, what you're doing is running monetary policy structurally too tight. And the reason they're doing this is because they let the inflation genie out of the bottle, and Powell wants to protect his legacy from that policy mistake by trying to put it back into the bottle. But newsflash, you're never going to get it back into the bottle, Jay. And we are in a structurally higher inflation economy. So just by the Fed acknowledging that with a positive revision to its inflation target, which would allow it to set more credible, more thoughtful, and ultimately more supportive for growth monetary policy, does not mean that healthcare costs for the elderly are going to go up or down, or, median age or anything. Like, these dynamics are already part of what's happening in the economy. The Fed just has to change its reaction function to acknowledge it. And an economy, like I said a week ago or so or two ago, An economy that grows 3 to 4% on a real basis with 2 to 3% inflation is so much better for the median earner and their real wage growth potential than an economy that's only growing 1 to 2% on a real basis, because the Fed is staunchly committed to a legacy and arbitrary 2% inflation target. One other thing to think about in this context is, we have an economy that has a tremendous amount of structural and structurally elevated refinancing risk across in every pocket of the credit markets, whether you look at the treasury market, whether you look at the mortgage-backed security market, and whether you look at the credit market. And that refinancing risk essentially says that, hey, you need to create some policy space, some monetary policy space for the consumers and businesses that are refinancing into this higher interest rate regime perpetually. You're essentially draining growth from the economy because you have policy rates too high as a function of that structurally elevated refinancing risk, which is the spread between the yield on those credit in those markets relative to the coupons that borrowers are currently paying. So obviously the coupons are generally fixed. The yields are what the market is currently demanding. We've had positive delta on that for about three and a half years now. And so we've just perpetually, in every facet, the treasury, people in the housing market, corporations, consumers, we've all been refinancing into a perpetually higher interest rate regime for the past 2.5 to 3 years, because the Fed is, trying to mop up the spill that they created, the massive spill they created with their previous policy mistake. If they never let the inflation genie out of the bottle, we'd already be at the Fed's own estimate of the neutral rate of 3%, which Treasury Secretary Bessent highlighted on Bloomberg on Wednesday. We'd already be there because we'd just be running credible monetary policy for the current conditions in the economy, which something we've been arguing for a while is that we've had this 3% equilibrium inflation rate. So, I think it's just a different way of thinking about this. The Federal Reserve is very anchored to its legacy of the Phillips curve and its legacy and arbitrary 2% inflation target. But the reality is there's a different way of thinking about this, and we're starting to hear the drumbeat of regime change circling the Fed. And again, like I said, I'm not alone. I'm not a tinfoil hat wearer. I'm a thoughtful, data-driven macro risk manager who's piecing the puzzle together at a very high level. And a lot of other really smart people from our industry and around the world are also starting to agree with me. And this is something I've been pounding the table on for 2 years now in the context of our investing during a forward-turning regime analysis. If you are in a fiscal dominance regime, the monetary policymaker has to play ball. If they do not play ball, then guess what's going to happen in a fiscal dominance regime? More of what's been happening, which is an exacerbation of the K-shaped nature of the economy. The treasury market is at the top of not just the domestic, the global capital structure. So in a fiscal dominance regime, when the treasury is supplying the world with a ton of treasuries year after year after year, 2 trillion plus or there about roughly $2 trillion budget deficits every year since the pandemic, or at least they've normalized it around 2 trillion. They were obviously much higher than that early in the pandemic. Because we keep draining all this capital from the rest of the economy, not we, the treasury, in the fiscal dominance regime, there's not a lot of capital left over, right? If you look at the next 12 months, so we keep a metric called the next 12-month marketable treasury issuance. That metric is the sum of debt that needs to be rolled over in the next calendar year. Obviously, we annualize the fiscal year to date budget deficit, so obviously the debt that needs to be capitalized, and then we annualize the rate of divestment from the Fed SOMA portfolio. So the sum of those metrics is the approximate amount of money that the approximate amount of treasury supply that's going to hit the tape over the next year, and that time series has gone from 3 to 4 to 5 trillion to now persistently 11, 12 trillion. And so think about how much more capital is being drained from the rest of the economy by the treasury year after year after year. If you look at it as a share of household sectors, household savings and corporate profits, the sum of those two metrics, it's about 40%, which is like double what it tends to trend at. It's the long run mean of the time series, inclusive of the big spike in the last half decade, is 22%. So the treasury is gobbling up almost double the amount of capital in terms of treasury supply year after year after year than it used to. And that dynamic means there's not a lot of capital left to go around in the economy, especially when you think about all the capital that's being drained by the development of AI and the data centers and the infrastructure build out associated with that, and energy and on all the other, and so on and so forth. So by the time small business America, is left, think about it like a dog, when like a dog gives birth, There's like 8 or 9 puppies. Like the big puppies knock the little ones out of the way and they get to the milk first. The big puppies is the treasury market and AI development and the infrastructure building out around that. And obviously anything that the Defense Department needs and demands. Those are 4 big sources of capital being drained from the economy. That doesn't leave a lot of capital left for the housing market. It doesn't leave a lot of capital left for small businesses. And so this is the problem with maintaining an arbitrary 2% inflation target. If you maintain an arbitrary 2% inflation target and keep monetary policy too tight for the small puppies who are trying to get access to the milk, they're never going to get any. And this is why we have a K-shaped economy. This is why so many people are so pissed off in this country, because they're languishing. There's no growth. There's no economic growth for half, if not more, than the country. There's no economic growth for the consumers and businesses that have been trapped on the bottom of the K-shaped economy because of terrible monetary policymaking. Well, in part because of terrible monetary policymaking. There's other factors. I'm not going to blame the Fed for this entire dynamic. There's a lot of problems. There's a lot of contributing factors, but boy, oh boy, is the Federal Reserve and U.S. monetary policy not one of the biggest. If you disagree with me, hit me up on Twitter, hit me up in the community chat. I think I'm going to win this debate. I think I have a lot of very credible sources on my side in this debate. And hopefully we win, because ultimately what it'll mean is a better economy that is better functioning with faster rates of growth and hopefully faster rates of median real wage growth, which will happen if you allow for more the development of more productive capacity in the economy. If you increase the supply side of the economy, you will get faster real median wage growth. But you can't increase the supply side of the economy when there's no capital left over for the consumers and businesses on the bottom part of the KJ. Stop protecting your legacy and start implementing sound monetary policy. So with that, we'll wrap it up. Darius here presenting our macro minute for Friday, August 15th, 2025. Best of luck out there. We'll catch back, or have a great weekend. We'll catch back here on Monday. Cheers.